All right, let's dive right in. We're going to talk about one of the most important steps toward financial independence, building passive income streams that actually work for you. We've put this whole thing together specifically for business professionals in India who are looking ahead to 2025. So let's get to it.
First, let me ask you a pretty direct question. Is your income completely tied to the hours you put in? I mean, if you decided to take next month off, would your income just stop? For most of us, the answer is a big yes. And that right there is the exact problem that passive income is designed to solve.
So, what are we really talking about when we say passive income? Look, it's not about getting something for nothing. Not at all. It's about setting something up, doing the heavy lifting up front, so that it continues to earn money with minimal, and I mean minimal, ongoing effort. It's about building assets that go to work for you day in and day out. Here's where the big difference lies. Active income, that's linear. You trade 1 hour of your time for a certain amount of money. Simple. But with passive income, you build an asset that generates money all on its own. The effort is front-loaded, sure, but the potential for growth can be scalable, even exponential. And honestly, that is the real game changer. Okay, so how do you actually build one of these income streams? We're going to break it down into two main paths. This first path is all about investment strategies. It's for the investor in you. It's about making your money do the hard work for you. A classic place to start is, of course, the stock market. Now, passive income here really comes in two main flavors. You've got dividends, which is basically your slice of a company's profits. And then you have capital growth, often through things like index funds that just track the whole market. In either case, the real magic, the secret sauce, is letting it sit for the long term and letting the power of compounding do its thing. And the path to get started is actually pretty methodical. It all begins with learning the basics. Don't skip this step before you even think about picking a broker like Zerodha or Upstocks. Once you're set up, you can focus on dividend stocks or those broad index funds tracking the Nifty 50 or Sensex. But the real engine for growth, that's in the last two steps, reinvesting every single rupee you earn and then just holding on for the long haul. Next up, real estate, a tangible asset that's been a cornerstone of wealth for centuries. It's got this amazing 1-2 punch. You get consistent rental income flowing in every month, and you get the benefit of long-term property appreciation. You can either do this the old-fashioned way by owning property directly, or you can invest indirectly through something called REITs.
So you've got these two main approaches. The traditional route is direct ownership, right? You buy a flat, you find a tenant, you manage it. The alternative is investing in REITs, that's real estate investment trusts. This lets you own a tiny piece of a huge portfolio of properties, giving you exposure to the market without any of the landlord headaches. Now, if you go the direct ownership route, it's pretty involved. You've got to research locations, get your financing sorted, find tenants on sites like Magic Bricks. But the most critical step to making this truly passive is hiring a property manager. If you don't trust me, you haven't bought an asset. You've just bought yourself a second job. For a genuinely hands-off approach, REITs are definitely the way to go. Okay, what if you have a lower appetite for risk? Well, there's the whole world of fixed income investments. We're talking about things like government bonds, corporate bonds, and of course, bank fixed deposits. These aren't really about explosive growth. They're all about steady, predictable returns, and most importantly, preserving the capital you already have. It really all boils down to a super simple trade-off between risk and return. Bank FDs, they're the safest place to park your money, but they offer pretty modest returns. Government bonds give you a little more return for just a tiny bit more risk. And if you want higher yields, you can move into corporate bonds, but you have to be comfortable with the company's specific risks that come with them. Your job is just to figure out where you're comfortable on that spectrum. The strategy here is a nice, simple loop. You pick your investment type, you shop around for the best interest rates, and you spread your money across different issuers to lower your risk. After that, you just hold on until maturity and reinvest the earnings. It's a patient, disciplined way to protect your wealth. All right, let's totally switch gears and look at our second path, business-driven models. If that first path was all about investing your capital, this one is about building a system, an engine that generates revenue without you needing to be there every day. This path is for the entrepreneur at heart. First up, owning a franchise. I mean, why build a business from scratch when you can buy into a model that's already proven to work? You get to leverage a well-known brand for a much faster start. The key, the absolute key to making this passive is hiring a rock-solid management team to handle all the day-to-day stuff.
So while the process starts with a lot of research and legal paperwork, the real pivot from being an active owner to a passive investor happens at step 4, hiring that manager. Delegating the operations is what truly frees you up. Your job then just becomes monitoring the financial performance from a distance.
Okay, this next area is just fascinating. Automated businesses. Think about businesses that can basically run themselves. Vending machines, self-service laundromats, maybe some kind of digital kiosk. The secret to success here is all about one thing: location, location, location. You've got to find those high-traffic spots.
The setup definitely requires some upfront investment in the equipment, but the key is to build an automated system around it. You use digital tracking to monitor sales, and you outsource the maintenance and restocking. Once you've perfected that model in one great location, the real power comes from scaling it up. Just copy and paste it into new locations.
Now, for the more experienced professionals out there, angel investing is a really powerful option. This is where you fund promising early-stage startups in exchange for a stake or equity in their company. Let's be clear, it is absolutely high risk, but the potential rewards, if that startup takes off, can be enormous. But this isn't just about writing a check and hoping for the best. It's a very structured process. You join a network like the Indian Angel Network to find good opportunities. You carefully vet the startup's plan and their team. You invest with a clear exit strategy already in mind, and then you monitor their growth, waiting for that profitable exit down the road. And finally, we have a really sophisticated strategy: licensing your intellectual property. If you have a patent, a trademark, or maybe even a unique business process you've developed, you can let other companies use it in exchange for royalty payments. This creates a recurring income stream from an idea you've already created. This whole journey literally turns an idea into income. It starts with your innovation, of course, but it quickly moves to the absolutely crucial step of getting it legally protected. Once your IP is secure, your focus shifts to finding the right business partners and negotiating a solid deal. After that, your main job is pretty simple: make sure they're following the agreement and cash the royalty checks. So wow, we've covered a lot of ground here. Everything from traditional stock investments to really innovative business models. Let's pull it all together now and look at the key takeaways for your own financial independence roadmap. So what's the big picture here? Well, as you've seen, the options are all over the map, from super low-risk bonds to high-growth businesses. But no matter which path you're drawn to, every single one of them demands some upfront commitment of time, expertise, or money. And maybe the most powerful strategy of all isn't to pick just one. True financial stability often comes from diversification, building several different streams that protect you from risk and help power your growth.
And that brings us to the final and most important question. This one is for you. Looking at everything we've talked about today, which one of these paths really fits your personal vision for 2025? Your journey to financial independence starts right now with that choice. Thanks for tuning in.